Well, hello, everyone. Today is March 4th, 2021. This is my spring rally video conference. So essentially, we want to know, normally March and April are very strong months on Wall Street. Last year, between February 19th, which was the high, and March 23rd, which was the low, the Dow Jones Industrial Average lost 35%. So, do we have to protect ourselves from a potential other loss? Or does the opening up of the economy, the vaccine being rolled out, hopefully every adult being vaccinated by early summer, everybody wanting to get out and do stuff, does that going to equate to increase in equity values and increase in real estate values? What can we expect from the spring rally and potentially even leading over or bleeding over into a summer rally? That's what we're going to examine in today's video conference. I'm going to pull up some charts and I'll be right back and we'll get started. Oh, hi. I did already provide a little bit of color before we started and a timestamp, but I'm back and I want to give you the bottom line. The bottom line is that the current prices for stocks, the spring rally and good news and the vaccine and a summer rally, even into 2 or 3 years from now, that's already been priced in. So if you put in anything that could be negative, that's why we see weakness. So a lot of stocks, we've seen Tesla go down 30% in under a month. We've seen some of the technology stocks are down 17% or more in under a month. And this has nothing to do with technology or electric vehicles not being hot. They're some of the hottest areas of the market. It has everything to do with valuation. So I'm going to take you through a few things, but what I mean to say is that will this spring rally look like last year? Okay, last year we got bad news a little early. Between February 19th and March 23rd, the markets dropped 35%. And then just when we thought this was really bad, because we'd only known for a couple of weeks we were in a pandemic at that point, then they started to recover because of the incredible and robust response by the Federal Reserve Board and the Treasury Department, printing up, and worldwide that was the case. They just printed up a lot of money. They tried to get it into people's hands, and they especially tried to get it into the corporations' hands so that they could get through the pandemic, which they thought could easily be a year long. So here we are, we've got the vaccine, but that doesn't mean that the spring rally is something we can rely upon. So let me show you why that's the case. Again, it could happen. There are certain things that could push it up, and there are a lot of things that could pull it down. So your best strategy is still to be diversified, leaning into hot industries, and technology is hot, underweighting the bailouts and the problematic areas, and having a rebalancing system so that when it get really high and your one slice turns into two slices, you know that you're supposed to sell that second slice and have that be a part of your bigger pie. And then that way, if prices go down, you've captured gains. And if they go down and your slice gets too small, you are prompted to buy more low. So again, the pie chart system will help you to do the right thing. Looking at the brokerage statements where the losses are in red, which freaks you out, makes you want to stop or stop loss, and the gains are in green, which makes you want to just keep going, that is not going to help you to be a successful investor. But the pie chart system does, because when a slice gets small, it's prompting you to buy more low. And when a slice gets large, it's prompting you to sell high and capture gains. That's a winning strategy, and that will help you no matter whether or not we have a spring rally. So let's dig into some of the data. So the first thing I want to share with you is that there are about 8 essential factors that could play into whether or not we have a spring rally. I call them hope, hot air hangovers, the vaccine, the pandemic hangover, inflation, asset bubbles, and financial instability. Now, I'm going to be posting this blog on nataliepace.com. You can access it by going to nataliepace.com/blog, or just dropping down in the menu and clicking on blog. Okay, so you'll be able to see this later tonight when I post it, or early tomorrow if it takes that long to get it posted. So you'll be able to see all of these different factors that could come into play. But let's just talk about hope for a moment. So people have pent up excitement. Like, everybody is so excited about walking outside and the potential for having everybody vaccinated so we can take off our masks, hopefully, and stand closer than 6 feet apart and go on a holiday. All of these things, this hope factor is real. And we are going to get a stimulus check, at least, anybody that's earning under 75,000, that's the middle class of America. So there's going to be a lot of people with a stimulus check, and they're probably going to want to either spend it or invest it. We've seen a lot of the millennials and Gen Z that prefer to invest it. There's a little problem with that because a lot of them are trading on margin. I'll show you that in just a moment. And a lot of them are following meme stocks, which look more like pump and dump schemes. So we have to know how to battle that and be on the right side of that trade. But the bottom line is that hope factor can play a big part of a rally. And if people are hopeful, then they could lean into stocks. What we've seen is that is not the case. Over the last 4 or 5 days, people have been selling off, especially technology, and that's a hot industry. The other ones are not nearly as hot as technology. So what's really happening? What is dampening the hope? Well, we also are seeing a lot of hot air. So there's a lot of meme stocks. And again, they look a lot more like pump and dump schemes if you look at them, because a meme stock, so this is something that's happening in the younger generation. They're going on the bulletin boards and they're creating films and they have their whole language, and they'll pick a stock, and sometimes it's a real loser like GameStop or AMC. These are companies that are on the brink of actually declaring bankruptcy, not necessarily going out of business, but perhaps sometimes they just do that to restructure their debt and come back hopefully leaner and more profitable. But they picked a lot of stocks and companies that were actually not doing that great. And the only thing they did was just say, give it a story. And then it would shoot up. Like GameStop shot up to almost $500 a share, but it stayed there for a matter of minutes. So if you really look at what happened there, and I can show you that real quickly, it looks way more like a pump and dump scheme than it does like, what we would hope to have, which is a great company that we buy low and we can keep for a while. But if it shoots the moon, of course, you're going to want to trim back some of your profits. So GameStop is at 132 right now, but here's what it did over the last month. So you can see that this is really marketing campaigns. And if you look at AMC, it's going to look the same. And we could put up Bed Bath & Beyond, which was another meme stock, and we could put up BlackBerry, and they all look the same. And you can see that you had only minutes to make profits. The same thing happened with our cannabis too. And again, the cannabis, unlike GameStop and AMC, is actually a growing industry with a lot of good prospects. But it hit the moon and then it shot back down. It was worth half by the following morning. So you have to understand now that this kind of hot air phenomenon, this bulletin board phenomenon, is real. Also, we've gotten accustomed to very lofty valuations, overvaluations. So again, when I say that the prices are the spring rally and the vaccine and the summer rally, and even on into 2023 and 2024, which is when the economy is really predicted to be recovered, that's already priced in. That's already priced in. So the smallest bit of bad news sends things going down. Or even just that something else is hotter will send the prices of equities going down. So we are going to get this handout. So the $1,400 check is a positive for the for stocks, especially because a lot of them are probably going to go to the younger generation, and they're really excited about this idea that they can become an instant millionaire, and they're really looking at this. So you might want to get to know how to read that Reddit site that is Wall Street Bets, so that you can see what they're doing, especially if it's something you already own. That's how I knew how to sell my cannabis on that day that it shot the moon, because I knew that all the other shoot the moon stocks on that bulletin board had a very short-lived trajectory. So the vaccine itself is something that people are looking forward to and saying, well, it's going to help the airlines recover. It's going to help office buildings recover, travel and entertainment. But what we're seeing is that some things are having structural shifts. So are people going to go back to the office? Do people really want to get out of their yoga pants or add to their day by having that commute again? Are they really interested in that? There are certainly a lot of technology companies that are understanding that their employees were as productive or more productive from home. And, eventually that could play out a big deal for helping them to have better husbandry of their bottom line. Because if they don't have to pay as much for office space and you can work from home, then obviously they're going to be more profitable, right? Additionally, we're seeing that the commercial real estate, I'm here in Manhattan right now, and I came to kind of kick the dirt, especially on commercial real estate and on Manhattan real estate. And we just saw a building that was valued at $460 million, owned by Jared Kushner near Times Square, that had a valuation drop to $98 million. It's currently entering the foreclosure process. So the price decline is unprecedented. That happened over 4 years. But again, this is something that's not being priced in to what's really happening. So we have a lot of asset bubbles, and I think you really need to understand this. So I'm going to pull up some charts here. The first one I wanted to pull up is just what I call the asset bubble chart. So as you can see, what I did is, why do I have June 2000, June 2007, January 2020, and then January of this year? Because this was June of 2000 was right at the beginning of the dot-com recession. June of 2007 was right before the Great Recession. So things were really high then. And as you can see, they're way higher now. The average home price is way higher. The stocks are way higher. You can also see that debt is absolutely astronomical. So consumer debt is way higher. Total debt and loans is far higher. But what you can see here, the reason I put it next to January 2020, which is before the pandemic, is so that you can see that this problem, what we would call over leverage, as well as overpricing, which contributes to financial instability, was already present before the pandemic. That's a problem for the spring rally too. And another statistic you may need to know is that over half of the S&P 500 is at or near junk bond status, and that includes a lot of banks. So AAA is the highest credit score, and BBB is the lowest. BB is junk bond status. So we do have a financial services company that is in junk bond status, but we have a lot of other ones that are close to it. And by the way, the amount of leverage that we have going on right now, we pull up the FINRA chart. So this shows us how much of stocks are being traded on margin. This is the highest it's ever been. What does that mean? It means that, people are borrowing money from the brokerage to buy stocks, and this is the amount that they actually have in their account. If they borrow money to buy stocks and they lose money, they're going to be in real trouble. So it's a problem. And it's also been contributing to the rise in stocks, which are overvalued by a lot of different measures. Let me show you those as well. So this is a chart I have been showing you guys for a while. This is put together by Robert Schiller, and the line you want to look at is the green and blue line. So if you look here to the far right, you see that today it's about 36. The average price to earnings ratio is 16 or 17. So this is double what normally is. And the only two times when it was this high was right before the dot-com recession when the NASDAQ lost 78% and took 15 years to recover, and the Great Depression, which, as you know, went on for decades. So we're at a very high prices for the markets. And just because you've gotten accustomed to it doesn't mean that it's normal or that it can stay there. As an example, can we have a company like Tesla that's valued in January at $900 billion when its profits are less than $1 billion? That's pretty lofty. And since January, it's only now early March, Tesla has gone down by a third. And so now it's more in the $600 billion valuation range. So just be careful thinking that your stocks are going to either stay where they are or even go higher because of a spring rally, which is usually pretty reliable, but certainly wasn't last year. So Nvidia is another one. This is a very hot company. It's got extremely high sales growth, but it was just overvalued. How do we know it's overvalued? I'll show you. So look at this. It had 61% sales growth in the most recent quarter, and that's a year-over-year sales growth. But if you look at its price and you look at its price to earnings ratio, it's at 78. The average price to earnings ratio is 16 or 17. Yes, high growth companies can take a higher price to earnings ratio, but that's very lofty. So and it was even higher before Nvidia came down. So Nvidia is down about 17%. All of the FANG stocks are down, even Apple. And Apple has been spending over $23 billion buying back its own stock every single quarter. It's on track to maybe buy back, up to well over 80 billion this year. So you can see here that Apple is at 120 and its high was 145. So even Apple is coming down. So the bottom line here is that a lot of this is already priced in, and we are going to have a little bit of inflation, and people think, oh, okay, so maybe I should move over to bonds because now I can get 1.75% for a 10-year treasury. Well, that's a problem too. It's okay if other people think that they should do that. As you know, bonds are losing money and they're illiquid. So I don't think that's a good idea. In fact, if I were you, I'd be reading the fine print on anything that I thought was safe. And I would definitely learn what's safe in a world where there's so much debt outstanding. So the bottom line is there could be a spring rally, but it is already priced in. And that means that it's also very possible that there will not be. Because what I've been seeing is that the institutional money and the hedge fund money, they've been taking things swiftly. So February 19th to March 23rd was the fastest it had ever gone from a bull to a bear market. And the reason for that is that the big money moved first. There was, a meeting in the White House, and all of those guys understood that the pandemic could be as pronounced as it eventually became. And those were the people that sold. Most Main Street investors were looking at me in March, like wondering what the heck happened, because that happened only 2 weeks after the first stay-at-home order was issued. So the bottom line is that the connected money, the big money, is moving fast. There are a few other specters in the wings. So the US AAA credit rating is on a negative outlook by Fitch. If Fitch follows suit and does indeed downgrade us like Standard & Poor's did in 2011, then they'll try to do that over the summer. So again, the vaccine, opening up of the economy, spring rally, all of this has already been priced in, overpriced in to the stock market, overpriced in to the real estate market too. I want to show you a couple of quick things about debt and leverage. So this is a very important report that I've been tracking. The most recent one showed that 5 million renters and homeowners missed payments. Now, of course, the rental and foreclosure moratorium is preventing you from seeing this. But what is even as distressing as well is the amount of people who are not paying their student loans. So that's a big problem too. That's 42% of student loan borrowers are missing payments. 42%. That's going to be hard on the financial services industry. Having commercial real estate, like we're seeing here in Times Square, the one that was owned by Jared Kushner, go from a valuation of over 400 billion to under 100 billion. That is going to be rough on banks too. So and when banks have a hard time, that's typically when we have economic hard times as well. So I think now is the time that you have to be more cautious than normal. We're overweighting 20% safe. Again, technology is hot. So if it continues to pull back, you might use that as an opportunity to start dollar cost averaging into a hot slice of technology. Cannabis is hot if it keeps going down, and it definitely took a big hit today. Again, you can either wait for that decriminalization news and have limit orders set so that if it becomes a meme stock again, that you can shoot the moon with it, or if it keeps going way down. And that also allows you, by the way, if you do capture your gains, if you keep a little slice in there, and if it goes down and the slice gets skinnier, it helps you emotionally to buy more low because you already made a lot of gains on it. All right, so thank you for joining me. I will open up the phone lines so we can have a conversation quickly. It won't be super long conversation, but I'm not going to record that part unless there's something in there that I think we all need to be privy to. All right, so I'm going to pause for now. So again, thank you so much for joining me. Be sure to check out the blog because it will go deeper and also link to a lot of the data sources. There's a lot of stock scams out there. And if you're getting things in your email, be very, very careful because there's newsletters that actually have 10 or 12 different scams that they run. And it's they're getting a little more sophisticated in not looking as much like a scam. So be careful about these kinds of tips that tell you about opportunities that are going to shoot the moon. Only if you do it right now and invest in their newsletter, chances are this is really not going to yield what you wish it to yield and will be a big money pit. So a couple of things that you have opportunities that are upcoming for you to continue your wisdom. I do want to share with you that we're going to have a stock masterclass this Saturday. So all you have to do is go to nataliepace.com, click on the menu, scroll down, and you can get additional information about the stock masterclass. And we also have, so it's this Saturday, we also have an options for beginners class. I don't think the options are for everybody, but if you are interested in them, then you owe it to yourself to do both of these. You can't really be a good at options if you're not a good stock picker because volatility is key. Then also we're going to have a financial empowerment retreat, and that's going to be April 24th through the 26th. It's online, so you can join us from anywhere. And the reason I want you to look at this now is that you will get the best price if you register by March 15th. So that means that you're going to have to do it before a week from Monday. All right. We also discount family members dramatically. As you can see, they're paying half off. So when you bring your second person, it's less than it. Well, it is half. If you put together a group of 5, the 5th person pays $99 if you register them in the early bird period, everybody in the early bird period. So we're incentivizing family members, family groups to come in together. So thank you so much for joining me. Be sure to watch this back at youtube.com/Natalie Pace, and also check out the blog. And I look forward to seeing those of you in the stock masterclass this Saturday, the options for beginners on Sunday, and then the next retreat online, April 24th through 26th, 2 days after Earth Day. So hopefully we're all sustainable and leading more sustainable lives. So thanks again for joining me. Again, you can reach us at info@nataliepace.com, or you can call 310-430-2397. Thanks.
Okay, thank you.
Thank you.